big spike in a couple of them. Devang Mehta from Spark Private Wealth Management is now joining in to discuss the market fundamentals and his top sectoral picks. Thank you very much for joining in. Devang, as we speak, we've clocked in a very good up move from the April lows. I think markets are up close to about 13-14%. Do you think the best of the alpha, the return, is in the price at these levels? How would you look at the setup for the markets for future gains?
Thanks, Reema, for having me on the show. It's always a pleasure to be on CNBC-TV18. Yes, I think very clearly we had a view for the last 6 months. I think entire narrative has changed. Look at what happened since September 27th, 2024, when markets sort of peaked out. And we saw a correction in October, November, December, Jan, Feb, a little bit of recovery. In April, again, as you rightly said, it made a new low. What has changed from there? Honestly, the macros have changed. Beautiful, it has changed. I think we talk about GST collection. We talk about a bit of consumption data showing a bit of spur. We also see that the government capex had slowed down. That has also come up brilliantly, and that is why the defense and the railway stocks and all are up. It's not just a story now. It's not just a narrative. But I think most of these companies will be led by earnings. So one thing which we saw is that the improvement in the macro set of data. Now macros also saw that the inflation came down, and nobody the last year was talking about rate cuts, which we saw an excellent RBI policy just last week, where defying expectations, I think 50 bips was cut, and again relaxation in CRR, which spurs the entire economy. It spurs banking, rate sensitives. I think most of the data points are increasingly becoming positive. The past earnings cuts that we saw the last couple of years, where earnings were sort of not delivering. In fact, this time, if you just sort of dissect earnings, we saw that the broader markets came up with good set of earnings, and more importantly, positive commentaries from a lot of sectors. So my sense is when macros are good, micros are good, market being slave of earnings, ideally also there were good cash flows operating as well as free cash flows by a lot of companies. My sense that probably for the next 6 months, 1 year, markets will probably head northwards. Yes, will there be correction on the way? There should be corrections on the way if this is a healthy rise. But I think, yes, I will be more positive than negative at even this point. Risk reward still looks quite interesting at this point.
Risk reward looks interesting. Devang, good morning. Thank you for joining in. Does this interesting risk reward apply to railway stocks as well? We just mentioned, we covered this last week on our editors roundtable, that despite the moves that you've seen, the valuations or their growth that you've seen over the last couple of years does not match up to the stock price rally that you have seen whatsoever. And despite this 30-40% move that you've seen over the last 1 month, the stocks are still almost 40 to 50% away from their record highs. What is your stance on this railway space?
I think I'll just try to just explain the situation. What is happening is probably be it railway, be it defense, be it power or energy, automation. What is happening is ideally, yes, if you sort of again dissect the Nifty or the Sensex, the benchmark indices, you would find that 35% is in financials or rather banks in Nifty, around 14-15% into IT, 10-12% into oil and gas, and maybe 8-9% into FMCG. Now, these are the traditional sectors where whether somebody wants to intend and buy something with an objective of probably earning 18, 20, 25% type of return over the next 3-5 years, is it going to be possible? My sense, it's difficult. Probably a 10, 12, 14% type of returns can be made on Nifty on the back of earnings growth. But the broader markets, and I think more and more, if you look at even the domestic investors and even FIIs, if you look at their holdings over the last 6-7 years, they are also getting into, I'm not trying to sort of broad brush the entire map, but I think beyond the Nifty, beyond the Sensex and beyond the indices also, there is so much that one can probably buy into, because India now is growing on 2-3 wheels, right? One being the capex, which was absent 5-6 years back. The second being discretionary consumption, which is extremely strong. Third being financials. Again, in financials, if you just take out the banks, and again, I'm not saying banks will not do well, but a lot of NBFCs, a lot of financials in terms of brokerages, depositories, exchanges, you already seen wealth management companies. I think all these sectors, and railways, defense are also part of that, where even the earnings pool are shifting. So if you look at earlier, the earnings were only concentrated towards the top 50, 100 companies, but I think it is getting spread out evenly. I'm not saying that everything will do well. You need to take out exuberance from that. But ideally, yes, I think a lot of other sectors, which we always talk about, be it power automation, energy efficiency, be it air cooling systems, I think a lot of this would come to the fore and start doing well if I think the broader markets earnings also come. And I think there is always a chance that all these earnings have seen good traction and they will maintain it for the next 2-3 years.
Where are some of the other sectors that you are finding value in, Devang? Where are you putting your money to work at these levels?
I think, yes, as I said, we believe in ideally the three themes which we always talk about, the three C's. The first being capex, and I think I've been talking extensively on this at the expense of being repetitive. We place our bets in a lot of capital good ancillaries. We feel that a lot of engineering companies, ER&D companies, good ancillary companies, lamination as well as stamping, power automation. These are sectors that I classify under a bit of capex and manufacturing, where if India grows on the manufacturing side, engineering side, capex side, this will benefit. The second C being consumption. Consumption, again, as we all know, we have seen strong discretionary consumption trends generally. The travel tourism as an industry, we have seen organized retail, particularly we used to talk about companies like Trent. I think this has also seen good bit of traction. Yes, the valuations have corrected a bit for a lot of such companies, but I think the space looks extremely interesting in the discretionary consumption upper end space. And the third being credit growth. Now, again, credit growth we have seen probably in the lower teens, and if this expands after the RBI monetary policy, we'll see banks doing well. We'll see NBFCs. We'll see other where penetration and density is low. Maybe broking, maybe wealth management companies, where I think people are going to probably put in more money. They're putting their money to work, and investments as a sector would also start doing well. So I think these are broadly the three themes which I think if one prepares a portfolio even today, it would reward them over the next 2-3 years.
Interesting. But Devang, there are also certain names here over the last few days that have done fairly well for themselves are the private financials, be it the large-scale private banks or the NBFCs after the RBI policy. Has the tide finally turned for them, or is the market discounting the pressure that NIMs are going to face because of these rate cuts by the RBI a little too much too soon?
I think probably what we saw is the last 4, 5, 6 months, while the recovery was led by a lot of other sectors as well, but financials led the recovery. And as we know, most of the banks which underperformed over the last 3-4 years, be it HDFC, be it Kotak, be it even ICICI, they all did extremely well. I think over here now, what one needs to monitor is that there are other sectors which I said which are part of the financials. Now today, if you ask me today, India's BFSI sector would be in terms of market cap around say 110-115 lakh crore out of 450 lakh crores, which is around 25% of the market cap. Now today, here banks would do well. Yes, over the next 5 years, they would give you 12-14% CAGR. But private financials, as you talked about, certain NBFCs, certain wealth management companies, here the growth rates can be 18 to 22, even 25% in certain cases. So I would place more bets. Yes, we would probably buy banks, but we'll buy other financials with a lot more conviction than banks.
Devang, pleasure having you as always. Thank you so much for sparing time and joining us today. Devang Mehta there of Spark Private Wealth. Take a short break here on Trading Hour, but before we do that, CNBC-TV18 Access is a premium membership-based service available on CNBC-TV18.com. It offers members exclusive content, market intelligence, and expert thought leadership. The membership includes access to CNBC-TV18's flagship events, interaction with our journalists, along with curated studio tours, e-learning sessions, and masterclasses, and curated lifestyle benefits. Designed for an immersive and enriching experience, it empowers members with a premium business intelligence and unique lifestyle benefits. The power of insight, the privilege of access, exclusivity, experiences, and influence is yours to claim. You can become a member by logging on to CNBC-TV18.com/access/plans.